Good afternoon, everybody. This is Lawrence Elbaum from V&E. We're here today to present, as part of V&E's post De-SPAC series, the topic of how shareholder activism is going to be creating a lot of issues for post De-SPAC public companies, whether those issues are going to be proxy fights, hostile M&A, and short attacks. We're here today to talk about how those De-SPAC companies are vulnerable and what those companies can do to get out in front of it. If we could just turn to the next slide to review the agenda. Thank you. So in a second, Patrick and I will introduce ourselves, but we're going to cover a range of topics today. First, we're going to lay out some recent statistics on what makes post De-SPAC companies ripe for different types of activism. Those types of activism will predominantly be short attacks, and then more traditional activism threats like a proxy fight or an unsolicited bid. We'll look into the different types of protections that most De-SPAC companies already have in place, and mechanisms that they could get in place if they don't have them already. We'll look at some recent De-SPACtivism targets, show an example of a company who was particularly vulnerable to a proxy fight, and make at the end some recommendations on what companies can do to get prepared for a potential attack. Just in terms of our practice, Patrick and I head up V&E's activism defense practice. It's one of the largest practices of this kind in the world. We have a large team, predominantly based in New York, but also based in V&E's other offices, most notably in Texas. Our group is defending more shareholder activism campaigns, and has defended more campaigns over the past 7 years than any other firm in the world. I think the count is now over 250 campaigns defended during that time frame. Our practice is industry and market cap agnostic, but we like to say we go wherever the fights are. And right now, a lot of these fights are in SPACs, so we are knee deep in a bunch of situations involving SPACs. Patrick, do you want to talk a bit about yourself before we turn on to the next slide?
Sure, I'll make it brief. Patrick Gadsden, co-head the shareholder activism practice with Lawrence here at Vinson, as he already articulated. For those of us joining just for CLE credit and who will be ignoring the majority of what we say, but clicking through to get the credit, we still value you hanging around, and then maybe you'll even learn a few things while you're here. But thanks for everyone for joining us.
Yeah, and thank you for everyone with their patience. We had to delay this a month because of an emergency. What we did learn was that during that period of time, we actually got more subscribers. I was expecting to see the subscribers drop off. Not that canceling CLEs and rescheduling them should be a tactic to get more subscribers, but the data doesn't lie. Next slide, please. Okay. So the case for SPACtivism is pretty self-explanatory. Over the past several years, a number of companies have gone public through a SPAC called a De-SPAC transaction. It's a type of merger. There are approximately 180 trading De-SPACs that closed in 2021. Only 7% are currently trading above their $10 IPO price. And if you look at returns for SPACs that closed in 2020 and 2021, they're overwhelmingly negative. Particularly if you look at 2021, the returns are negative 64% for all De-SPACs closed during that year. It's less in the previous year, but I think the point is there has been a lot of value that has been destroyed, which usually creates a breeding ground for shareholder activists. We'll get to why that is the case in a second. So another phenomenon that we've been seeing that's been precipitating these stock drops has been short attacks. We'll talk a bit in detail about what short attacks are in a moment. But we have seen a number of de-SPAC companies, and the numbers growing, face short attacks year in, year out, and we're expecting that trend to continue. So what ends up happening, whether the stock's dropping because of business reasons or macro or microeconomic reasons, or whether the stock's dropping because there's an aggressive short and distort campaign by a short attacker, the end result is a stock price that is depleted, possibly a company that has intrinsic value that's greater than its market value, and now you enter the shareholder activists looking to unlock that gap between where the market perceives the value and the actual value of the company. Patrick, do you want to talk about why these companies are particularly vulnerable?
So de-SPAC companies are vulnerable to activism for the same reason that any companies who are vulnerable to activism are vulnerable, and that's performance, right? Whether it be market performance or operational performance, you still see the remaining vulnerabilities. Now, I think we don't need to go over the market performance of SPACs. I think we all kind of know that it's been poor, and I think Lawrence just did a good job of stating that. But operationally, SPACs have historically been, or de-SPAC companies have been disproportionately high growth, low revenue companies, right? And in a bear market, or in a market in which financing is prohibitively expensive for young companies or recently listed companies, those metrics of low revenue, high growth aren't necessarily a great recipe for strong companies. They're a recipe for companies that, in all likelihood, may see themselves preyed on by activists because of operational concerns, right? And so, when you think about these companies, you also have to realize that de-SPAC companies are also particularly vulnerable because we've had a high redemption environment over the last year or so, right? So you're talking about companies who aren't coming into the markets with, we'll call them bazooka balance sheets. They're coming in pretty weak and without a lot of capital from the de-SPAC process left over because of the high redemption environment they were in coming into the de-SPAC company. All of that creates an environment in which, activists are going to look at this company and say, look, market performance has been terrible. Everyone knows that. But in addition to that, this company operationally may not survive for long unless I step in, I being the activist, step in and do something productive, change the board, et cetera, et cetera. We'll get into what the activist tactics may be a little bit later on. But that's sort of the recipe behind why these companies are particularly vulnerable. Now, we have a nugget below that, lays out that there's been twice as much activism activity in the de-SPAC space this year as last year. Yes, a lot of that has to do with a growing universe of de-SPAC companies, but a lot of it also has to do with just the nature and operational performance and market performance of these de-SPAC companies being particularly poor over the last year. Lawrence?
Another interesting thing about this slide is, because we had planned to do this presentation a month ago, we pulled up the data forward, I think through this past Friday, and it got worse. And I think if we even pulled it forward the 6 days from the last day we updated this, it continues to get worse. So companies continue to be in this ripe zone for one of the two types of activism here: short activism or more traditional activism.
And in terms of traditional activism and vulnerability, sort of an inside baseball view of why some of these companies are particularly vulnerable. Coming from having represented many activists in my previous life, one of the things activists do look out for in terms of governance and mechanics is how seasoned the CEO is. And if you have a very new CEO or to a public company, or CEO doesn't have a lot of experience in public companies, that's seen to be a hallmark of vulnerability, because in the minds of an activist, less seasoned CEOs are more likely to be more pliable, more receptive to what the activist has to say, go along to get along, all of which make targets like these SPAC companies who, historically have had more green CEOs more vulnerable. Go ahead, Lawrence.
No, thank you. That was great, Patrick. So what is a short attack? We've been reading a lot about short attacks the past several years. Obviously, what went on with GameStop last year brought the short investment industry to the forefront. In its most simple form, a short investor borrows money to buy stock at current market prices. They sell that stock into the market at current market prices, and they have an obligation to pay back the money they borrowed in the future. If they pay back that money in the future and the stock price has dropped, they can pocket the difference after buying back the stock and paying back the difference between the two prices for the stock. If the stock price has gone up in the interim, then the short investor has to come out of pocket to make up the difference between what the market price was when the money was borrowed and what the market price has gone to as it's gone up in the interim. So that's what a short investor does. That's how a short investor makes money. What a short attack investor seeks to do is de-risk the possibility that the price of the security will go up during the period in which they have to pay back the loan that they took out to buy the stock. And the main way that a short attack perpetrator will try to do this is through what's called a short and distort campaign. Usually that's done with a white paper or a presentation or a website that's press released over the newswire, that's launched on a dedicated website about the target of their particular investment. And the short and distort campaigns usually take on a range of forms, but at their core, the short and distort investor are making claims about the financial viability of the company. That is the viability of the company's financial statements. They are also making allegations about the viability of the company's business model, about the truthfulness of the company's business model, and statements they're making about the environment in which they operate. And also in a world where ESG is a major focus, particularly environment in the case of short activists, where companies have made very specific pronouncements about sustainability. On occasion, the activists in the short world will look at the assertions the company has made about sustainability and try to pick them apart. And the reason that the short activist does this is to create fear in the current shareholder base of a particular company. That's the target, to make them think that their investment thesis is no longer as strong as it used to be, to cause them to sell their stock. Why? Well, then the short activist can buy back stock at lower prices, and when they pay back their loan, they could pocket the difference. The other thing that short activists do is they try to get friends, and this is, by the way, the case in regular activism as well, which Patrick is going to discuss. They try to get friends to also come in and gang tackle the company by making the same bet on the stock price going down. The unfortunate thing is that there, in long activism, which Patrick's going to discuss in more detail, there's plenty of regulation, particularly with the SEC. There's also antitrust regulation, and there's other state and federal regulation as well. There's much less regulation in the world of short attacks. And why are SPACs ripe for short attacks? Well, as Patrick mentioned earlier, there are a number of companies that were high growth but very young companies, that some folks would call, two college students a clipboard in a boardroom, who are now being thrust into the public company sphere. And perhaps their companies were just not ready for prime time. They're good ideas, they're honest individuals, but the company's pronouncements of what they could achieve in the public markets might not have been as substantive as they originally had hoped. That gives the short attacker significant grounds to attack the company's business propositions, the environment in which they operate, and also to look very carefully at what the company was claiming it was going to do in their prospectus and what they've actually done in ensuing quarters. That's why we're seeing a lot of SPACs become the targets of these short attacks. More generally, scores of companies each year are subjected to short attacks. So if you're a de-SPACed company and you're facing a short attack, these things generally come out of nowhere. You might see the short interest of the company growing over time, but there's no way to predict when a short report from an activist is going to launch, whether it's through a press release or through a website launch. There's really no way to predict it. And usually the first question that boards and management teams will ask us is, well, how do we respond? What do we do? We have to rebut everything right away. We need to bring a lawsuit. We need to get the SEC involved. This is horrible. And what other strategies do we have to make this an economically prohibitive exercise for the short attacker? Do we have insurance? We typically caution the companies that we're working with in responding to a short attack, first and foremost, on their public communications. Usually there will be a lot of inbound inquiries from investors, business partners, other constituencies, employees, about what's going on. The stock price is dropping. What are you going to do about it? When are you going to speak? What are you going to say to instill confidence and restore confidence in your ecosystem? And usually companies are best served, if they're going to come out with a press release, to come out with a press release, and there are plenty of examples of this, just reminding shareholders to be very skeptical of what they're reading. We caution companies not to retweet the negativity from the short report, but to call out that perhaps for long investors of the company, they should question the motives and intentions of the short activist who profits on the stock price going down, as opposed to the other investors who profit in terms of long-term appreciation in the stock price. That's usually the first thing the company does. And then it behooves the board and management team, depending on the types of allegations that are being made in the short report, to start running them down, issue by issue, fact by fact, triple verifying everything. The biggest mistake that we see companies make is coming out categorically denying things that really need to be run down very carefully. Number one, categorically denying something that you later have to admit to part of does not look good in the court of public opinion. It won't look good in court, and it will raise more questions than it will answer with regulators. So we recommend, if you're going to speak be very frugal about your speech. However, there are other options to speak. Research analysts typically come out after a short report has been instigated, and if you have good relationships with your research analysts and they understand your business, and you spend the time with the research analysts in peacetime, making sure they understand the fundamentals of your business and how you make money and how you will make more money, A lot of times the research analysts will hold on their recommendations, or maybe they'll even increase their recommendations in terms of whether folks should buy or consider raised price targets. Having third parties validate your thesis is the strongest validation. Of course, a company coming out and retorting everything tit for tat could always result in a follow-up report by the short activist, which would cause more stock price declines. On the other hand, when other folks outside of research analysts, news reporters, third-party experts, other folks in the media come out and say positive things about the company and its business, it validates the company, but it also indirectly undercuts the thesis of the short activists and can help keep the stock price stable or going up during one of these short attack situations. A lot of companies ask whether litigation or regulatory intervention is a possibility, and we always love the idea at first blush, punching back with something that aggressive. What we found is that oftentimes the subject matter of the short attack is covered by free speech protections, and it can be very hard unless something is patently specious and false to have litigation create the end of a short attack or put a short attacker out of business. And we haven't seen much SEC regulation in terms of enforcement actions against short activists. There have been a few, but there has to be, again, demonstrably false and misleading information. You know, for instance, if it's a healthcare company and there's a doctor explaining in the short report for the short attacker why the healthcare company's medicine is bad, but the doctor declines to let shareholders know that he has an investment in the fund of the short attacker, that's fodder for regulatory intervention. That's highly misleading to shareholders. But short of something that bad, it's tough to get the regulators right away to jump in and kill a short attack. Patrick, I'd like you to talk about capital markets, but just in terms of D&O insurance, companies should always look at their D&O insurance policies when there is a massive stock drop or significant allegations are being made about the business. There could be D&O coverage in your primary layer of coverage in your D&O policy, and it could be without a deductible. There's some public companies that could have hundreds of thousands of dollars of coverage, no deductible, to put a team together to restore investor confidence. The insurance companies love this because they believe that putting a team together to stem one of these attacks actually can prevent the bigger issue, which would be an SEC investigation or a major shareholder lawsuit. But Patrick, there are some options that you actually educated me on.
Oh yeah, for sure.
How to make these economically prohibitive.
Yeah, and I also want to touch on a few points that you also mentioned, or one in particular. So when thinking about litigation, we always want to remind clients that initiating litigation sometimes brings counter litigation, and with that, discovery. And that creates an opportunity for information related to the subject matter that you may or may not want to see the light of day, seeing the light of day. So it isn't just sort of a sword to use. It can be used against you and it can backfire, especially if there are things related to the short attacks allegations that may or may not be kind of true, right? So we always want clients to keep that in mind. Another thing we want to make sure that we touch upon and recognize is the rise of anonymity. So, short attacks in general aren't anything new. Commodore Vanderbilt was dealing with short attacks in railroads in the 19th century. So this isn't a new phenomenon. What's new is how technology has sort of warped what used to be traditional PR campaigns waged by short attack artists. and the rise of social media compounding that by creating sort of blanket anonymity around many short attack artists who aren't name brand hedge funds, right? But who may otherwise be, unscrupulous actors who have taken large short positions, whether they be, sort of illegal and naked or otherwise. But it makes it very difficult for companies to get their arms around sometimes who exactly are the real players behind a short attack. And with, the rise of social media, and particularly the fake, quote unquote, fake news bot phenomenons, it creates a circumstance in which, put yourself in the seats of a retail investor. You aren't super sophisticated about social media, but when you check the ticker symbol on your Twitter account, all you see is just bad news, hate, terrible things about the company. You may or may not think to yourself, oh, wow, 90% of these comments are bots, right? You're just going to be thinking, I maybe need to change my investment. I maybe need to liquidate. I maybe need to get out of this. I'm a mom or pop, right? So we do recognize that a lot of what we're saying can be made particularly difficult because of the rise of sort of the more anonymous short attack artists. But, to the extent you can, there are ways around that, whether that be, doing your best to hire a forensic analyst to delve into exactly who are the folks behind some of these, campaigns online, whether it be, Seeking Alpha or Twitter or Facebook or what have you. There is a digital footprint. And, it can sometimes lead to finding out the actual identities of the underlying players. It's rare, right? But it can actually be used, and sometimes it does work. And then you can also, do other things like checking whether or not there have been, a number of FOIA requests, and determining, okay, well, this is really interesting. Wow, this is one person who's consistently making these requests, and seeing if you can sort of tie those requests and the persons behind those requests to a lot of what's going on in terms of, the social media and the internet activity, right? In addition to that, you can, delve into maybe not the actual names and identities of the players online, but at least if they are repeat players, you can check their habits, right? Even anonymous avatars in this short space have habits. They have particular times of day that they like to tweet. They have particular events that the company announces that they like to follow on with negative coverage in the internet space. So you can sort of be able to predict, to a certain extent, the actions and the reactions and the second order consequences of what you may put out as PR, and what may come back to you from these anonymous actors. So wanted to make sure we touched upon that. In terms of capital markets options, really, this is just your traditional, toolkit, right? And it's obviously more useful for more seasoned De-SPAC companies. But what we're talking about isn't doing anything that appears to be directly reactive to the short attack, right? It's more leaning into your already available capital allocation toolkit, shareholder return toolkit, capital return toolkit, whether it be share repurchases, increasing of dividends, maybe even a special dividend, very, 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 very rare circumstances. But those are all elements to apply economic pressure to the ongoing short activity that, may not break them, right? But it could slow down the acceleration of short interest in your company. And in addition to everything else Lawrence articulated, it could be a lever to use, especially if you already have a share repurchase program that you've announced, or you already have plans on increasing your dividend, to sort of seamlessly integrate that into what Lawrence articulated as a broader plan can be pretty useful in terms of trying to counter a short attack. Lawrence?
Yeah, also directors and officers and significant shareholders buying stock in the face of a short attack can also be helpful. Of course, if you're a director or officer, you have to deal with the window, whether or not your trading window is open, whether you have MNPI, even if the window is open, for certain directors rather than other directors and officers. But showing the market that the the folks inside the company continue to have faith and continue to reach into their pockets with after-tax dollars to buy stock in the company is a real great way to speak without speaking. The investors pick up the Section 16 filings and the other SEC filings immediately, and you usually react pretty positively to it. Of course, if there are significant investors that are not insiders in the board or in the company by virtue of being a director or officer, them buying stock as well can be a very good full-throated endorsement about the company's business and sentiment among significant shareholders.
So I'm going to take off my shareholder activism defense cap, my Jedi cap, and I'm going to put on sort of the dark side Darth cap that I used to wear when I only represented activists, and go through how shareholder activism is implemented by activists. So all of this is usually around the theme of unlocking value. What that means is increasing the share price, usually in the short term. But how it's implemented by activists is done through a pretty, basic, easy to understand playbook. First, it starts with private pressure. Now, usually the private pressure would begin, we would start 6 to 8 months prior to making anything public. But with de-SPACed companies, that timeline might be a little bit truncated because you may be dealing with a company that hasn't been public all that long. So your private pressure vis-a-vis, trying to set up calls between the IR people internally at the issuer and maybe an analyst at your firm or the hedge fund principal, trying to arrange conversations with potentially the principal of the hedge fund and members of the board, all of that to allow the activist to share its thesis for change with the company. So it's important to remember that activists are not in the business of getting board seats, right? So if they share with you their theses and you adopt their theses, whatever it may be, even if it's something as extreme as, sell the company or form a strategic alternatives committee to evaluate selling the company, that may indeed make them, pacified enough to go along their merry way. However, if you as a board realize that many of the activists' concerns either aren't valid or many of the activists' suggestions really wouldn't improve the company in any material way, and you decide to, tell the activists, thank you, but we won't be doing these things for very good reason, then the activists might move on to the second step, which is public pressure. Now, this is where things can get particularly nasty. Press releases, fight letters. A fight letter is a letter drafted by an activist to be critical of the company and its performance, whether that be during sort of an actual, nomination campaign type period or before. Any sort of vehicle that an activist could use to be in the public sphere and be critical of the company, including, television, C-SPAN, all that stuff. So that's kind of how it escalates. And all of this would be around being critical of management of the company and the board and its decisions related to strategy and operational performance. The next step, if the public shaming in activist speak was not successful, would be the launching of an official campaign. Now, this would involve sending the company a compliant nomination notice that lists the activist's own nominees for directors who could be eligible to be elected by shareholders at the upcoming annual meeting. We won't get into the universal proxy and how that sort of, is involved in all of this. We can leave that for a different time. You could email us if you have questions about it. But at the end of the day, this is a political contest at the annual meeting that the activists foist on the company to challenge the company's incumbent directors. It can be extraordinarily costly for both the activist and the company, usually slightly more costly for the company for a litany of reasons. We're talking millions of dollars spent, an enormous amount of management time soaked up dealing with it. It can be a bear of a problem to deal with and manage, especially for a company that's young or a company that is restructuring or trying to get its sea legs with a new strategy. All of these, are things the activist knows, and it knows that in all likelihood the company will do anything within its reasonable power to avoid a proxy fight, and the activist tries to use that as leverage to potentially extract an overly favorable settlement, but a settlement nonetheless. And sometimes you can reach a good, healthy balance and get settlement and peace without sort of surrendering the shop. The next bucket of potential activism activity is M&A activism. This, over the last few years, hasn't been so much hostile M&A or unsolicited M&A, but bumpertrage. And what bumpertrage is, it's an activist term of art for publicly complaining or agitating for an increase in the premium that has been offered and accepted by a board that has decided to sell a company. This can be a letter, this could be something in a 13D/activist type filing, or it could also be contesting the sale itself by submitting your own proxy to go out there and collect shareholders' votes against the sale of the company. So all of these are buckets of activism. The only other slight bucket I will mention has to do with things called withhold campaigns. Not as rare as they used to be. It used to be very, very rare, but since approximately 2016, 2017, we've been seeing them more frequently. What this is instead of an activist submitting its own names for nominees to contest the company's incumbent slate at an annual meeting, the activist will just say, I don't have my own people, but I don't like these people, and we need to have a referendum on their performance so they understand how grievous things have been for shareholders in the short term. And so I'm asking you to send me your proxy so I can withhold in all the company's candidates. Sometimes if the withhold is significant enough, and if you're dealing with a professional activist, the withhold can result in the activist following the annual meeting coming to the company and saying, look, 80%, 90% of shareholders withheld on the company's incumbent candidates. Here are some names of a few people that I think would be great board members. I think that the company's candidates should resign and they should be replaced by these new candidates whose names I'm submitting to you. That is a more powerful threat if the company has a resignation policy, which compels directors who fail to receive a majority of shareholder support at annual meetings to submit their letters of resignation to be considered by the company in its sole discretion. But even without that, activists can sometimes persuade companies to change board composition based on really poor results in the wake of a withhold campaign. So those are the major buckets of activism and how it can be used in SPACs along with companies in general, De-SPAC companies, and companies in general. Lawrence? Next slide.
I would just add that the reason that De-SPAC companies are seeing these forms of activism, again, as we said earlier, is the decline in stock price overall and the market valuing the company less than activists may believe the company is intrinsically worth.
Thanks, Lawrence. So we'll move on to the next slide about what we'll call prototypical De-SPAC corporate governance provisions. So, I don't think it's a secret that De-SPAC companies tend to have pretty heavy-handed governance regimes from an activist perspective, right? From a shareholder's perspective. For many reasons, this sort of regime may be something that is useful or necessary, especially for a very young company. Unfortunately, in the minds of most institutions and proxy advisors, these sorts of, more quote unquote strict or harsh governance mechanics are not viewed very, very favorably. So staggered classified boards, shareholders not having an ability to act by written consents, shareholders not having an ability to call special meetings or having extraordinarily high thresholds to call special meetings if you aren't in a shareholder base that's very consolidated, having supermajority vote requirements for shareholders to amend bylaws and or charter, blank check preferred, not as much of an issue for institutions and proxy advisors. Choice of forum, companies that have failed to opt out of DGCL 203, and the granddaddy of all shareholder quote unquote unfriendly governance mechanics, dual class voting structures. All of these are seen to be very strong indications from an activist perspective of entrenched board mindsets, right? That isn't necessarily true, but it is something that activists try to use in their campaigns as evidence that there needs to be change in the boardroom, particularly change in the Nom and Gov committee, which is held to account for a lot of these board mechanics, to sort of change the mindsets and the governance mechanics to make them a lot more shareholder friendly. Some of these governance mechanics, even outside of an activist contest, can be viewed pretty harshly by the proxy advisors, particularly the staggered classified board. If you are even a fresh IPO company and you have a staggered classified board and there's no sunset provision in your charter, it's standard practice for ISS and Glass Lewis to recommend withholding on each of the members of your board on the Nom and Gov committee who are eligible for election until a sunset provision is folded into your charter and bylaws, or until your board is declassified, right? So if that is the sort of reaction you're going to get from the proxy advisors in an uncontested situation, you can only imagine their sort of reaction in a contested situation when things like this are being highlighted and you're dealing with a separate subset of members at the proxy advisors who particularly focus on contested situations and have a very critical eye of quote unquote shareholder unfriendly governance mechanics. So each of these is helpful in that it does protect and sometimes insulate management from we'll call undue adverse disruption. But the flip side is each of these can be used by an activist to wrap themselves around in the flag of good corporate governance and point their fingers at management and the board and say, look, these are just indications that you're dealing with an insulated, entrenched board that does everything within its power to prevent shareholder democracy. So it can be helpful, but on the flip side, it can be pretty damaging from a PR perspective if you're an activism campaign. Lawrence?
I couldn't agree more that these are double-edged swords. They're usually very strong, but setting aside the dual class structure, everything else, they're very good protections to prevent short-term attempts to grab control by an activist, but they're not that effective to prevent an activist from trying to get one or two seats. That's where the double-edged sword becomes an issue, because then these defense mechanisms can make an otherwise good-looking board seem to be entrenched, and they'll be starting with a disadvantage in an activism campaign, particularly if there's bad performance. The next slide, please. There's some unique elements that are making De-SPAC companies ripe for these more traditional types of activism. So remember, it's a different world today than it was a year ago. A year ago, there were so many SPACs. The year before, so many SPACs, all in search of targets. There was a target-rich environment, and every day it seemed several companies were going public through a SPAC, scores and scores each year, and sometimes they went public so quickly. There were groups of shareholders that together, when they agreed, had control over the company, but they didn't bind themselves together with shareholder voting agreements that governed how they would vote arm in arm. And what's happened over the past year in particular, stock prices have dropped, and if some of these shareholder groups, maybe they're 20% shareholders that did have control over the company at one point. If one of those shareholders or two of them now have misaligned interests from each other and are looking for liquidity because their funds are hemorrhaging with their other investments, they now may be looking to drive changes at the company so they can get to that liquidity. Of course, had there been agreements between these shareholders at inception on how they'd vote, they would be locked up for a period of time. There are also obviously a number of shareholders post-IPO that have come into these companies when initially stock prices rised with the IPO. They've lost money. They're pushing for changes. But there's another very interesting phenomenon with founders. A number of these companies, and Patrick and I mentioned this earlier, these were sometimes they're family businesses, sometimes they're founders who are in the earlier stages of their careers or maybe in the middle of their careers, who permitted their nest egg to go public through a SPAC because they couldn't get access to capital in the same way otherwise. And they're now looking to get control over their investment. So we're seeing different types of investors getting frustrated. And because in a lot of these situations, they're not bound by voting and standstill agreements, they're free as soon as the company's first annual meeting, if not sooner, if special meetings and written consents are a possibility, to run an activism campaign to try to get board representation or to try to get the company sold. Now, there's another interesting phenomenon, which Patrick and I have seen in a number of situations. We're not going to name specific names, although we do have a few. We saw a question about case studies. There are a few targets that we'll talk about I think it's on the next slide, but this is a big one. Most De-SPAC companies are in Delaware. In Delaware, companies have to hold their annual meeting every 13 months. If they do not hold an annual meeting, when 13 months and 1 day passes, a shareholder can run to court in Delaware and petition for a meeting. And usually that meeting will be held within 45 to 90 days after the petition is filed. The very interesting thing here is that the companies that went public through a SPAC, the SPAC shell is the public company in Delaware that's required to have an annual meeting every 13 months. And a lot of SPACs have never had annual meetings. A lot of SPACs were formed, and usually the 13 months runs from the date that the SPAC is formed and incorporated. And a lot of companies mistakenly believed that the De-SPAC transaction vote, where the new board got constituted an annual meeting to elect directors. And it's not, unless those specific proposals for each director are on the ballot. So what we've seen a lot are situations where a company is performing poorly, does not have a staggered board or does have a staggered board, and they're getting pressure to hold an annual meeting immediately because of this rule in Delaware. So we urge all SPACs that are on this webinar, that are not on this webinar, if you have not held an annual meeting in the past 13 months, check whether or not you are in violation of this rule in Delaware. If you are, you're at threat of an imminent petition for an annual meeting to be compelled by a shareholder. And if you haven't performed well, you could be at risk of board seats being replaced. So take a close look at that. I think on the next slide, we have a few examples of activism campaigns against De-SPAC companies. The reason we have F45 on here is because Mark Wahlberg is on the board of that company. It's a fitness company, and this company's lost about 90% of its value during the first year after its De-SPAC transaction. One of the founding shareholders, Kennedy Lewis, which owns about 15% of the company, filed a 13D recently, and then even more recently has made a bid to buy the company at a price that I believe is under where the company's high was several months ago. The company's formed a special committee. They're evaluating options. They appear to be doing the right thing in response to an unsolicited offer. But here you have a mix of the types of activism that Patrick discussed earlier. Number one, you have a 13D filer looking to influence the board and business. That 13D filer has now become an unsolicited bidder, and now there's a target on the company. That one is still in play. Another company, UpHealth, again, this one had several groups of large shareholders who were threatening to upend the company's annual meeting this year to replace a majority of the board. Ultimately there was litigation over this, and the campaign was withdrawn, but it was in the press, and the company's bylaws and the fact that it was potentially delayed with an annual meeting did come into play. Thankfully for UpHealth, they ultimately were cognizant of the Delaware annual meeting rule, and it wasn't used against them, but there was litigation around it. Likewise, in Faraday Future, we saw a situation where the activists recently settled with the company. There were significant shareholders, and a number of folks resigned from and left the company. And just this morning, I'm not going to talk about Sentinel-1, that was third point. Just this morning, Starboard launched a campaign against Veritiv, which I believe is a data center company. Interestingly, I think the stock is trading above IPO price, but still is, I believe the thesis, it's lagging its data center peers. And Starboard, I believe, filed a 13D this morning. We'll see how that one plays out. If we could just turn to the next slide quickly. Not going to name the company here, but this is an example of, we mentioned companies going public very quickly, not having shareholder agreements. Here's an example of a company that had a blank in its bylaws surrounding how shareholders are supposed to make nominations for the company's first annual meeting. So, most public companies have a bylaw that says if you want to nominate directors or make a business proposal, you've got a month to do so, and it's about a month. It's a 1 month period, about 3 months before your annual meeting. Well, what happens if you've never had an annual meeting before? How do you calculate when that month opens? Usually the bylaw has a method for calculating when your window opens for nominations for your first annual meeting. This bylaw right here attempted to do that, but left blank the most important date possible for a shareholder to figure out when nominations or business proposals would be due. So this company could have been facing a threat of a shareholder, a group of shareholders, without an advance notice bylaw, showing up at the company's annual meeting and wiping out the entire board. So the lesson from this one is, if you've not held an annual meeting yet, or if you have held an annual meeting and you're a SPAC, take a close look at your advance notice bylaw. There are probably some changes you could make to it because of universal proxy, which can be the subject of a whole different webinar, but make sure that all of your blanks are filled in. And if you've never had an annual meeting yet, make sure that that advance notice bylaw absolutely without question applies to your first annual meeting, so that you're not surprised when the polls open at your annual meeting with nominations that come out of the blue. Next slide. Patrick, I think we have about 5 minutes left. So I'll please get through as many of these as you can.
Yeah, so we'll move pretty quickly because I know we're short in time, as Lawrence just said. So one of the first things you need to do if you find yourself in a position where there's a realistic probability that you might be in an activism situation is you need to review your own structural governance mechanics, particularly when is your nomination notice deadline, not your 14A8 proposal notice deadline, your nomination notice deadline. And for companies that have never ever dealt with activism, it's probably something that they've never even really thought about, other than maybe a sentence or two in each year's proxy statement. But you need to know when is the window that you can expect to receive nominations. Because prior to that window, you need to, in all likelihood, be checking your record shareholder list to see if there has been any change to your record shareholder list, because that is one of the canaries in the coal mine for activists. Most companies have a record shareholder nomination requirement, meaning that you have to be a record shareholder in order to make nominations. So keeping your eyes on that record shareholder list prior to the nomination window opening, very critical. Also, you want to make sure you have a ready to go, fully negotiated with your transfer agent, on the shelf poison pill. Now, if you don't have a 13D filer, there may be some thought to, well, we don't have, that many 5% or any 5% shareholders in our stock. Do we really need to negotiate a shareholders rights plan and keep it on the shelf? We don't think in all likelihood we'll be subject to an aggressive shareholder buying up a bunch of stock in our company. That really isn't the best mindset, considering that by the time someone blows through 5%, especially if they weren't a 13G filer, so there's no cooling off period, you could be in a situation where they are actively and aggressively moving through your stock. And now you have to draft a shareholder rights plan, fully negotiate with your transfer agent. That takes days. During those days, the activists can continue to buy stock. So you want to make sure you have a poison pill ready to go. Second is you want to do a full, from an activist perspective, corporate governance analysis. So from the activist perspective, the governance analysis is very different than, say, an uncontested ISS governance analysis of your company. From an activist perspective, they're looking at the structural governance that you have, bylaws, charter, and what their rights are, and substantive governance that you have. The amount of stock that your directors bought with post-tax dollars, as Lawrence articulated earlier. I'm trying to pull those through here. So you want to make sure that you are looking at everything from the perspective of an activist. Next, you want to make sure that you're having an advisor do a full financial self-evaluation. Now, this is not just in the absolute. This is relative to an honest peer group, right? Not a peer group that makes you look great, a peer group that probably makes you look not so great, because that's the peer group the activists would use if you find yourself in a campaign. Companies have been criticized for using dishonest, quote unquote, peer groups over the last few proxy seasons by proxy advisors, and you do not want to find yourself in that bucket. When you're thinking about this full financial self-evaluation, you want to tick through what are genuinely considered to be the activist buckets of evaluation. TSR, and I do understand that when you're dealing with a relatively new company, TSR isn't as important, but you still want to make sure you have your arms around it. A CAGR analysis, a median analysis of your peers and their performance in all of the relevant metrics and their KPIs, and a multiple analysis for your stock relative to your peers. Out of all of this, what's probably most important is you picking a proper peer set. That doesn't mean using the peers that you have in your proxy for compensation purposes. Those peers traditionally aren't deemed by the proxy advisors to be peers that are appropriate for determining whether or not they are your actual industry competitors. Sometimes you want to even look to correlations between your stock price and stock prices of other companies to determine whether or not ISS, Glass Lewis institutions will consider them to be your peers. It's a really deep analysis, but at the end of the day, it really boils down to who are your peers, how have they performed, how have you performed vis-a-vis them, and making sure your peers are reflected in an honest peer set. Lawrence?
The last few things here are look carefully at your shareholder base at all times, talk to your shareholders, be intellectually honest about how you're performing and what the outlook looks like for your business. To the extent you have these holes in your armor that we've just gone over about your advance notice bylaw, have you held an annual meeting? Do you have large shareholders that are not subject to a voting commitment? Look at those in a relative period of peace before the house is on fire and the sky is falling, because when those things are happening, it's very tough to get everything in order. And lastly, for boards and management teams that don't know exactly how these types of campaigns play out, a presentation similar to this can be given so that the boards and management teams can go through the different dance steps and rehearse before they end up in a live situation. I do not have anything else. I think we've addressed the questions. I hope that the the polling questions were easy enough. And on behalf of Patrick and the V&E activism team and the firm, thank everyone for attending. And we're always happy to answer any follow-up questions. Just email or call.
Thanks, everyone. We tried to get through the immediate action items as fast as possible. So if there are any follow-up questions, please let us know, because we tried to move through the last slide as quickly as we could.